Hello everyone. So guys, we are going to discuss today types of foreign currency risk, but let me connect the information because we are into unit number 8, right? And we know in the corporate finance section, we have these units actually. We have a unit number 4, 5, 6, 7, and 8. So these 5 units are the part of corporate finance section, and it is going to be your 20% of exam, these 5 units. And we are into unit number 8, and in unit number 8, so last time we discussed about 8.3 topic. Okay, and I have made actually 2 videos for this. The first video was for exchange rate, the basics of exchange rates. And then second video, I have explained the exchange rate system and appreciation of the currency. Okay. So now actually we will start today 8.4, which is exchange rates again. And here we will discuss the factors and risk mitigation. Okay. Factors mean to say those factors which may affect your exchange rate, and the risk mitigation mean to say we have some risk mitigation techniques. But before moving to this topic, I want to explain 3 types of exchange rate risk which we may face. Okay, so those risks are written actually in topic number 8.5, but as per my understanding we should understand first the I mean to say the types of exchange rate risk, and then we will move to topic number 8.4 so you can understand easily. Because once you will open the question for 8.4, so you will see the questions from the topic which I'm going to start now first. Okay, the types of exchange rate risk. So here we go. So we have here guys types of foreign currency risk, actually foreign currency risk. So first risk which we face, that is what transaction risk, and the second risk which we may face, that is what is called economic risk, and the third risk which we may face, that is called what, translation risk. So these three risks are important. So here we go. So first, I'm going to start with the transaction risk. Let me give you example here. For example, we can create example. Let's assume today is 15th of December and you are going to buy some goods. Okay, you are going to buy some goods from foreign country. Or simply what I'm saying, you have, let's assume you are going to import some goods. Okay, so this is 15 December today. So you are going to import some goods from foreign country. Okay. Now guys, obviously against these imported goods, you have to make foreign currency payment, right? And I am assuming that this transaction is on credit. Okay. This transaction you made on 15th of December, but this transaction is on credit, and maybe you are going to settle in the month of January of next year. January of next year, you will make the payment actually. Okay. And now, guys, please remember, in between these two dates, I'm assuming we have 31st December, which is our year end, which is our year end. Now, guys, please remember here. So at 15 December, the spot rate means the current rate of the two currencies could be different, right? And at the end of year, the exchange rate could be different again. And at the end of at the time when you are going to settle the transaction, which is January, again the exchange rate could be different, right? Now the point is that how you will consider the difference of these exchange rates. Okay, obviously the fluctuations in the exchange rate can give you loss or it can give you profit, right? Both way are possible. So actually this is what is called transaction risk. So now I'm going to explain here what is transaction risk here. So transaction risk is the risk of an exchange rate changing, when exchange rate is changing between the transaction date and the subsequent settlement date. Okay, like at the transaction date exchange rate could be different, and at the time of settlement exchange rate could be different. if we have year end in between, again at that time exchange rate could be different. Okay, so obviously it can give you either gain or what, loss, okay, due to the fluctuations in the exchange rate. Now here guys, you also need to remember here. So now I'm going to tell you here, like this word I'm going to explain. So what is the gain or loss, which is actually realized gain or loss? Okay, and what that is called actually realized on settlement. And there is one more word. There could be a gain or loss expected on unsettled transaction. So let me tell you here. First, I'm going to explain what does mean by gain or loss on unsettled transactions. So here we go. So if you will look at here, because we entered into the transaction on 15th of December, right? And by the end of year, this transaction is not yet settled, right? So it means if you will take the difference of this exchange rate and the rate which is prevailing at the end of the year, so this will give you gain or loss on unsettled transaction, because this transaction by the end of year is not settled, right? But when you will have a gain or loss on settled transactions on the settlement. So for example, if you will again for example, if you will, if you are sitting now in January, when you have to make actual payments, so at that day whenever the gain or loss you will get, so that is called gain or loss on settled transaction. Okay, unsettled transaction means the transaction which is not yet settled, and settled transaction means the transaction which is settled means you have paid or received the cash. Okay, so now the question is, please remember, so whatever the gain or loss you will calculate even on unsettled transaction or on settled transaction. So this gain or loss you will record in the income statements. Income statement means say in earnings. Okay, simply if you have a loss, you will take it to the income statement. If you have a gain, you will take it to the income statement. So how it will work, let me show you with the help of example. And also remember here, so this gain or loss will affect your cash flows, right? Obviously, due to changes in exchange rate, if you will have a loss, so you are losing money again, right? If you have a gain, so you are gaining money. So this transaction risk will affect your cash flows. It is not only the accounting risk. No, no, no. So it will actually affect your cash flows. So please remember, they may ask you the transaction risk effect, so you should remember that. So the transaction risk may affect your cash flows, and it is always included in the earning means say into the income statement. So now I'm going to explain with the help of example how you will deal with this exchange rate. So here we go. So for example, on December 15 year 1, B company purchased electronic components from K company. So actually B company is going to buy some inventory, you can say, from the K, okay? From the K corporation. B must pay K, how many yen we have to pay? 15 million yen we have to pay. And when you have to pay actually? On January 15 year 2 you have to make payment. Okay? So it means this is the transaction date when you initiated the transaction, which is 15th December year 1. And this is the settlement date when you will actually make the payment, which is January 15 year 2. And you know, in between these two dates, there is a year end, which is 31st December year 1. Okay, so this is the year end, right? So now guys, so please remember, now we need to know what were the exchange rate at the time of transaction date. Then we also need to know what is the exchange rate at the time of balance sheet date. And we should also know what is the exchange rate at the time of settlement date, okay, which is January 15th. So I'm assuming here, guys, I'm assuming here, for example, at the date of transaction, when you initiated the transaction, and your transaction is obviously in a yen, right? In yen, in yen. Okay, so I'm assuming you are US based company, so you are importing goods from Japan and you have to make payment of 15 million yen. Okay, and this is the date when you entered into the transaction. And at this date, now we assume here at this date, so what is the rate? So rate is we can assume the rate is given here by the way in the question. So we can assume 0.01015 dollar, this is dollar, equals 1 yen. Okay, so it's written here, the what was the exchange rate? They're saying the exchange rate in effect on December 15 when you initiated the transaction, year one was how much? Dollar 0.01015 per yen. It means 1 yen is equal to 0.01015 dollar. Okay, now what you will do here? So how you will do the counting now and how you will deal with these exchange rates? So at the date of transaction, which is 15th December, so you got a yen. You have to make payment in yen. How much? 15 million. So we will take 15 million and we will multiply with the exchange rate. Okay, what is the exchange rate? Exchange rate is here. 1 yen equals this much dollar. So we will multiply here. So I will also explain some. So what's the rate? Rate is 0.01015. Okay. Now please remember this is the yen and this rate is in the dollar. So whenever you have a rate in other currency, okay, so you will always multiply. Now here, if this is the yen and your rate, your rate is also provided in the yen, so then you will divide. This is the rule always. Okay. So here we have payment in a yen, but rates are available in dollars. So now what we will do, we will multiply. So if you will multiply this yen with this dollar, so you will get amount how much? You will get 152,250 you will get. Okay, what it means, let's understand in simple way. Because you want to buy yen, right, even in the future, so you have to buy yen. And if you have to buy yen to make payment, obviously, so you would pay dollar, right? You will pay dollar. So it means yen you have to buy, but rate is given in dollar. Okay, so that's why if you will multiply, so you will get this much dollar. It means as per spot rate, which is on 15 December, so as per this rate, so if you will sell this much dollar, so then you can buy this much yen. Okay. So now this is the value of transaction at the date of transaction. Now what entry you will pass? Obviously you will debit the inventory and you will credit the accounts payable because you have to settle this transaction in next year. I mean, it's on 15th January, right? So you will debit the inventory, credit the accounts payable with this value. Okay. So debit inventory with this value 152 250, and we will credit what? We will credit the accounts payable with the same value 152 250. So this is the value of liability at the date of transaction as per current exchange rate. Okay, now what happened? Now guys, at the end of year, we are assuming at the end of year, what is your year end? So 31st December year one. This transaction is so far is this transaction is not yet settled, right? So far, right? So at this date, we exchange rate has changed. And what is the exchange rate? We are assuming this is the exchange rate now. 0.01010 per yen. Means say 1 yen equals 1 yen equals how many dollars? Dollar 0.01010. This is what is the price of yen. Okay, guys, now what we will do at this date, we at this date we will calculate what? So we will convert that 15 million yen, okay, by using this rate which is prevailing at the end of year. So now again we will do the calculation and we will see what adjustment you have to do. Again, we will take 15 million yen, okay, this 15 million yen, okay. 15 million yen you will multiply. What is the rate? Dollar 0.1010. Oh, sorry. I think so it is. This is the rate, right? At the end of reporting date, this is the rate. So rate is what? Dollar 0.01010. If you will just convert again as per this rate, which is prevailing on the balance sheet date. So just we will convert it. So 15 million times 0.01010. So this is going to be 151,500 dollars. Now you have to check, okay, what was your previous value of your liability, because you have booked your liability, right, with 152. You have booked your liability with 152 250. You have booked your liability, right? But as per year end exchange rate, so value is how much? 1 151,500. So now tell me your liability value has increased or decreased due to change in exchange rate. So now your liability value is 151,500. Tell me your value has increased or decreased. Obviously, your liability value has decreased. So is it a gain for you or loss for you? Definitely, it is going to be a gain for you. How much gain is the $750 your gain? Now, what you will do at the end of year? Because your liability has reduced, right, due to exchange rates. Previously, you were thinking you have to pay 152 to $50 to buy 15 million yen. Now, as per exchange rate, you have to pay 151,500 to buy 15 million yen. So you got again 750. So what entry you will pass for this gain? Obviously, you should know the entry also. So gain is 750. So how would you record at the reporting date at the balance sheet? So you will debit the liability. You will debit the liability now because liability value has reduced, right? So you will debit the liability. We will debit payable, which is your liability, by 750, and we will credit the gain of 750. And this gain where you will record obviously in the income statement. Understood? And this liability will reduce by 750 because previously your liability was 152 250. Now deduct 750, so this will be remaining your liability, which is 151 500, right? If you will record this entry. Okay. Now guys, please remember at the reporting date now. So what is your liability value? I'm just writing it here as a reference, your liability, remaining liability, because previously it was 152 250 a transaction date. Now liability has reduced by 750. So liability value is 151 500. This is your liability value. Now what? Now we are moving to the actual date. And can you tell me this whatever gain we got, it is on settled transaction or unsettled? So far it is on unsettled transaction, right? Now what? Now we will move to the January 15 year 2. On January 15 year 2, we are assuming this is the rate which is prevailing. What is the rate? 0.01020 per yen. Like this much dollar equals 1 yen. So what you will do again? So again, you will remeasure your liability. Again, you will remeasure your liability, and how you will do it? Just take again 15 million yen into rate is what? 0. Now this is the rate, right? 0.01020. This is the rate. If you will just convert into dollars, so this is going to be how much dollar? Because this is the dollar. Okay, so how much dollar? Just convert it. 15 million times 0.01020. So it is going to be 153,000. So this is the value of your liability at which date? At 15th January, 15th January year 2, right? This is the value. Now you have to check what was the value at reporting date. At reporting date, liability value was how much? Liability value is at reporting date, previous value. So previous value was how much? 151,500 was the value at reporting date. Okay. Now tell me, now you will compare these two figures. Tell me you have a gain or loss because as per reporting date information, so you have to sell this much dollar to buy 15 million euro. But now as per settlement data, you have to sell $153,000 to get 15 million euro. So tell me you have a gain or loss? You are going to pay more. So it means you are going to have a loss now, right? Loss of how much? 1,500 is the loss. Right along the difference of these two. Now, guys, what you will do here? Now, because this is the settlement. Now on 15th January, this entry you will pass. On January 15th, this is the settlement date. This is your settlement date now. Okay, settlement date. So what entry you will pass? So this is what entry you will pass. You will first debit your payable, which was showing at reporting date. It was 151,500. Sorry, 151,500. This was the liability at reporting date, right? And now you will credit cash because this is what actually you would pay dollar to buy 15 million and at the settlement date, which is 153,000. And obviously the difference is 1,500. So this is going to be your loss. Okay. Due to changes in exchange rate. So it will be debit because difference is on debit side. So you will record loss. And this loss you will record into the income statement. Understood? This is how you will deal with the transaction risk. Now, guys, this is how it can be tested in question also. Let's have a look. So this is the question. So here we go on September 22 year one. This is the first date you are provided. Year one. Okay. A corporation purchased merchandise from unaffiliated foreign company for 10,000 units of the foreign company's local currency. So understand here, please. It means this is the foreign currency because they told you 10,000 units of foreign company's local currency. It means this is 10,000 units is the foreign currency. Okay. 10,000 is the foreign currency. Then they're saying on that date, means at this date, at the transaction date, the spot rate was how much? 0.55. Okay. So you bought some merchandise. So can you tell me if you know the spot rate at the transaction date? Okay. So what you will do here, this is a foreign currency and this is your rate is given in dollars. So I'm assuming dollar is your local currency. Okay. Your local currency. So can you tell me what will be your debit, what will be the value for inventory and payable, for example? So the value should be what? So just I'm doing here because rate is 0.55. So what we will do first, we have 10,000 of foreign currency. This is foreign currency. Multiply by rate is what? 0.55. So it is going to be, if you will multiply, it is going to be $5,500. Right or wrong? So you should pass the entry debit inventory 5,500 and credit what? Credit payables by what? 5,500. This is the at this this entry you will pass at September 22 year one. Okay. Now what we will go through next. They're saying that the corporation paid the bill, like this transaction is going to be settled in full on March 20 year 2. Okay. So we initiated the transaction on September 22 year 1. But this transaction is going to be settled when? On March 20 year 2. On March 20 year 2. It means in between these two dates, there should be a year end also, right? Right, there should be a year end which is 31st December. They're saying when the spot rate was 0.65. Please remember this spot rate is March. This spot rate is at March 20 year 2. Okay. But here we have another information. They're saying the spot rate was 0.7 on December 31st year 1. So this is the spot rate which is at the end of the year actually. Okay. So I'm just writing here. Let's have a look. So what is the rate at 31st December year 1? So spot rate is what? So spot rate at that day rate is what? $0.70. $0.70. This is the rate. Okay. Now what we will do? Again, we will convert this currency. We will take this 10,000, which is the foreign currency, multiply by this rate, $0.70. So it will give you how much? $7,000, right? Okay, now tell me, previously your liability was booked with this value. Now, as per this rate, your liability should be 7,000, right? Your liability has increased or decreased? Yes, it has increased, right? With which value? With 1,500. So if liability has increased, it means it's a loss to you, right? So now what? So what entry you will pass? Can you tell me if there is a loss? So you will debit the loss, which you will record in the income statement by 1,500, right? And you will credit what? You will credit the payables. You have to increase the payables by 1,500. Now I'm asking question. My first question, what is the liability value at balance sheet date? So previously your liability was booked with 5,500. Now your liability has increased by 1,500. It will be equal to what? 7,000, right? Equal to this value. Right or wrong? And if I will ask you what value will go to the income statement, so then you would say this loss will go to the income statement. Loss of how much? $1,500. Now let's continue the question. because question is just for year end only. That's why I am stopping here. So they're saying that what amount should the corporation report as a foreign currency transaction loss in its income statement for the year ended 31st December year one. For the end of 31st December year one, what loss? Obviously, you have a loss of how much? 1000 and 1500, right? Because this is what you have done at the end of year. So loss of 1500 is your loss. So this loss you will report. This is your answer. But now I'm changing question. Actually, for this question, answer is 1500 loss. Can I just change the question here? I'm just changing the question here. I'm saying that, I'm saying that here, by the way, answer is how much? 1500. D is the correct answer. We got the answer. But now I'm just telling you how you will deal the situation if they will change the question. Now my question is, instead of year one, I'm saying that what loss or gain? Loss or gain. You will record in not in year one, in year two. What will go to the in year two income statement? Gain or loss, whatever. Okay, what will go to the year two income statement? How would you do it? Our question is over here. No. Now then we have to consider the year two data also. The in year two at the settlement date, which is March 20 year two, the spot rate was 65. So let's do it now. I'm moving now March year two, right? March year two. At that day, rate is what? Dollar 0.65. Now again, I will convert 10,000 units of the foreign currency into 0.65. So the value will be 6,500. And in the previous balance sheet, just in the balance sheet, our liability was showing at 7,000, right? Now it is reduced to 6,500. Do you have a gain or loss? Because now as per this rate, the liability should be 6,500. So you got a gain. But what entry you will pass here? Because this transaction is going to settle. At this date, it is going to be settled. Right? You are going to pay finally. That's it. So what you will do? You will first debit the liability. The which liability? This value which is showing in the recent balance sheet. You will debit. You will remove this 7,000 and you will credit cash by how much? 6,500, because this is what ultimately you are paying. And now you can see the difference is on the credit side. Difference is on the credit side 500. So this is actually going to be your gain. If difference is on credit side, this is gain because your liability has reduced from 7,000 to 6,500. So 500 gain would be recorded in year two income statement. In year two income statement, this gain will go. Okay, we'll record this gain. Understood? Clear, guys? Is that clear, guys? Now, guys, we are discussing second type of risk that is called economic risk. Okay, economic risk you can say. So what is economic risk? So guys, please remember here. Actually, first thing, it is the law. It's theoretical thing. Okay, so no calculations are involved here, but you have to understand, please. So actually, it is. You can say the economic risk is the long term version of transaction risk. Okay, but don't say it is transaction risk. I'm saying it is the long-term version of the transaction risk. So I'll explain the difference at the end. What is difference? Why I said it's a long-term version of the transaction risk. Okay. But let's understand first what is the economic risk. For example, for example, they're saying the economic risk is the variation in the value of the business. They're saying your business value may vary. Business value means say what? Value business mean to say the present value of future cash flows. For example, you are exporting goods, okay, on every year to, let's assume, any country, to any country, right? And you are doing this business for the last 15 years, and obviously maybe you have a setup like that, and you will continue in the foreseeable future also, right? Now what? Because you are exporting, right? You are the exporter here, right? You are exporting goods to the other. Let's assume I'm just saying this way. So now obviously every year maybe or every month or every year you will get the money, right? and you will receive this money over the years. I mean to say every year you will receive, and for many years you will receive. This is what I mean, right? So now what? Every year the exchange rate may change, right? And the exchange rate may change, and you may suffer some losses also, or you may get some gain as well. So, but that's why I'm saying that economic risk means say it is a variation in the value of the business, means say the present value of the future cash flows. Okay, due to unexpected changes in the exchange rate. So it is the long-term version of the transaction risk. Okay, now the question is here, this point you have to understand, it's really important, because every year if you are receiving some money from the foreign countries, so proceeds may change if the exchange rate will change, right or wrong? So long-term version means every year you are receiving. So maybe you have investments there or something like that. Now, guys, here they're saying that here for an export company, for example, you are, I'm just assuming here, for example, China. Okay, you are living in China, assume you are living in China and yuan is your currency, right? And for example, you are exporting goods to USA. Okay, it means what is happening now? It means Chinese company will receive dollars, right? Let's assume Chinese company will receive dollars. Okay, now here, so it means Chinese company is the exporter now. I know currency is a little bit tricky, but what I can do. So Chinese company is the exporter here in this transaction. Now they're saying that a strong a stronger home currency makes exports more expensive in the foreign market, potentially reducing the competitiveness. So look at here. You know what China is doing actually practically? China intentionally weakening his currency actually. Okay, he's actually depreciating its own currency. The reason, because if Chinese currency will depreciate means that then the US customers will think this way, because we are exporting goods. US customers will think this way. Oh, if they will spend $1, $1, so they can get many yuan, right? Many yuan they can get. So obviously, then if the Chinese currency is weak, it's like same like that. For example, Pakistan. If you are living in USA, okay, and if you will convert $1, maybe you will get 280 rupees, right or wrong? It is good for USA customers because they will spend less, okay, and they can get more money, or they can get the better products, or products with the more money, right? What I'm trying to say here. So if they will spend $1, it will be a bigger money in Pakistan, right? Right or wrong, I'm just giving example. So they're saying that for an export company, it could occur because a strong home currency makes exports more expensive. This is rule here, guys. That is why China is devaluing its currency, right? Because if China will depreciate its own currency intentionally, so what will happen? Chinese product will become more cheaper for the foreign people, right or wrong, and they will prefer to buy. So that is why if China now think, this is general rule, guys, everywhere it is applied. Those countries who want to boost their exports, who want to increase their exports, so what they do, they devalue the currency. They devalue its own currency. Its own currency. Own currency means say its local currency. They will devalue, right? If they want to increase the export. But what will happen if if the local currency will be appreciated? For example, if local currency appreciates, so then what will happen? Exports will go down. Why? Because when local currency becomes expensive, so obviously the your goods will also become expensive for the foreign customers. So this is the rule first, remember, guys, because this rule will help you to solve many questions. So if you want to boost the exports, what is better? So we should devalue our currency. Local currency should be weaker then, right? If you want to reduce exports, then you have to appreciate your local currency, because when you depreciate your local currency, so your product will become more affordable to foreign peoples. But when you appreciate your currency, so your products will become more expensive to the foreign users. Understood? So this is what they're saying that now try to understand this statement. They're saying for an export company, it could occur because a strong home currency, okay, if you will make your home currency strong, so your export will reduce because your product will become more expensive. This is what I said, right? So this is what they're saying. The strong home currency makes exports more expensive in the foreign markets, potentially reducing the competitiveness. So it's not a good sign. It's a risk to the exporter, right? Risk to the exporter is what? If you are exporting, so risk is that your local currency may become stronger. If it will become stronger, so your product will become expensive also. Understood? And obviously, the if you have competitors, if you have, because there might be competitors maybe from other country like Japan, from other country, they are also selling goods in USA. China is also selling goods also. China is also selling goods in the USA. So if your currency, Chinese currency will become stronger, so Chinese product will become expensive in the US market, and this will give the benefit to the competitors, right or wrong? So if you want to increase your export, so then what is better? So your currency should be weaker. If it will be weaker, so your product will become more affordable to the foreign customers. Okay, this is what I'm trying to say. Now, if you are, please remember here, if especially now economic risk, how it will affect you. Now try to understand. If you are dealing with one country, or if you are, for example, exporting to one country only, so changes in the exchange rate may affect your obviously cash flows in long term, right or wrong? In long term, maybe every year you are receiving pay foreign currency payments, every year you are receiving. So if exchange rates are changing, right, so you are at the risk. This is what is called economic risk. So now the question is that how economic risk can be avoided, or can be not, can be avoided, I should not say, can be mitigated. How it can be mitigated? So the recommended solution is diversification. That don't do the trade, okay, or investments only in one country. Because if you are investing your whole, or if you are doing trade with one country, so then you are dependent on the exchange rate of that country also, right? But you should diversify. Diversify means say, like, try to export your products to different countries, so then you will not be exposed to the risk of one currency, right or wrong? So through the diversification, you can mitigate this risk. This is what they're saying. The recommended solution is diversification, where businesses expand internationally and reduce dependence on any single economy, right? Thereby mitigating the risk associated with the exchange rate volatility. Now the question is, what is the difference between economic risk and the transaction risk? What is the difference? Okay, the difference is the economic risk differs from transaction risk as it focus on the long term cash flows. But the on the other hand, the transaction risk focus only on what? On a specific transaction. You know, we when we were calculating gain or loss on settled unsettled transactions, so we were focusing only on one specific transaction. This is the difference. Okay, this is the difference. But the similarity is that economic risk may affect your cash flows also. Transaction risk is also affecting your cash flows. This is similarity, you can say. But the difference is, so the economic risk is its focus on the long term, but the transaction risk focus is on the short term, or you can say on the specific transaction only. This is the difference. Okay, I hope so it is clear. Here we go. Now we have a third risk, which is called what? Translation risk. Okay, translation risk is what? I can just explain here. For example, you have a parent company in India. I'm just quoting example here. We got a parent company which is in India, and we got one subsidiary, mean to say your group member subsidiary. I hope so you understand parent and subsidiary, right? So, for example, we got investment in USA. Let's assume our subsidiary in USA. It's in USA. Obviously, this subsidiary will prepare its own financial statements, and this parent company will also prepare its own financial statement first. And at the end, what we do, we consolidate, right? When we consolidate the financial statements, guys, so obviously, because this USA company is preparing financial statement in dollar, and maybe this Indian company, they are preparing financial statement in Indian rupees. So what we will do? So these dollars we need to convert every year to Indian rupees to consolidate the financial statement. And due to changes in exchange rate, again you may have a gain or loss. Okay, so for example, let me quote the example here. For example, this USA company is having one asset, and the asset value is denominated in dollar, that is $1,000. And in year one, so the exchange rate was what? $1 was equal to, for example, 60 Indian rupees. So if you will convert this dollar, because you want to show in the consolidated financial statement, if you will convert this asset with the worth of $1,000 to Indian rupees, it will be how much? $1,000 times 60 Indian rupees. So it will be, the asset value will be 60,000 Indian rupees, right? So it means this asset will be recorded in consolidated balance sheet with what? 60,000 Indian rupees. Now what happened? Next year, year two, year two. This was year one. Okay, now year two. In year two, rate is different. $1 equals what? 70 Indian rupees, for example, due to any reason. So now again, what we will do, same asset we will convert now, $1,000. Okay, because every year you have to convert by using the year and exchange rate. $1,000 times 70. So asset worth now how much? 70,000 Indian rupees. Okay, great. Now what? It's 70,000 Indian rupees. Now again, they will record this asset at what? 70,000 Indian rupees. Actually, guys, previously this asset was recorded at 60, and now this asset is recorded at 70. So how much gain you do you think there? How much gain is there? 10,000 Indian rupees. Okay, 10,000. This is called translation gain. What is translation gain? Or it could be translation loss also, right? Because if this value instead of 70, if it is 50,000, then this will become translation loss. So this gain or loss is called translation gain or loss. And how would you define translation gain or loss? Here we go now. I give you example now, just we will go through. So where the reported performance on the overseas subsidiary in the home based currency term is distorted in consolidated financial statement. As I told you, when you convert your foreign assets or liabilities into your local currency just to prepare consolidated balance sheet, due to changes in exchange rate year to year, so values can change. Right or wrong? And due to change in values, you may have a gain or loss. Actually, please remember, this is just an accounting gain or loss. Maybe it is not going to affect your cash flows. Transaction risk is going to affect your cash flows, because this is what asset is in USA. Just you are converting that same asset every year to your local currency just to prepare the financial statement. So that's why it's more about accounting gain or loss. It's not a cash based. Maybe it is not going to affect your cash flow. Okay. So now, guys, this is what is translation risk. I hope so you understood. Now this is note is important. Make sure you are able to distinguish between the three types of foreign currency risk. Okay, which three risk? Transaction risk, economic risk, and translation risk. So guys, this video became very long. So here we have a question. Actually, this question is relevant to the previous class, I think so. We studied last time. So, but I just want to give you again idea. They're saying given a spot rate, it's a current rate, dollar 1.8655. A 90 days forward rate is what? Dollar 1.8723. This is spot rate, means a current rate. This is forward rate, means this is the rate after 90 days. Okay, this is the rate which you are expecting would be in 90 days. Okay, the pound sterling in the forward market is. Now you have to tell which currency got weaker or stronger. Okay, so here we can see here in the spot rate what, just see how I'm explaining. Spot rate was what, guys? The spot rate is dollar 1.8655 equals 1 pound. This is the spot rate, right? It means if you will, for example, against 1 pound you can get this much dollar, assume this way. For every 1 pound you can get 1.8655. Now what? In 90 days, forward rate is what? In 90 days, what happened? The rate became this. For example, our rate will become this dollar 1.8723 equals 1 pound. Equals 1 pound. Now tell me, it means here for every 1 pound you can get this much dollar. Tell me you are getting more dollar or less dollar against 1 pound. Tell me, guys. What do you think? More or less? because as per spot rate, if you will give £1, you can get $1.86, let's assume. But as per forward rate, if you will give £1, you can get $1.87. You're getting more, right? You're getting more dollar. Now tell me, it means we can say the pound has appreciated, right? And the dollar has depreciated. Because I can say the pound became stronger and the dollar became weaker here, right? Because here previously against £1 you can take only $1.86, and now against £1 you can take $1.87. So you can get more dollar against £1. It means pound has appreciated and dollar has depreciated. And wherever the word appreciation is there, it means that currency is at premium. And where the word depreciation is there, it means that currency is at a discount in the forward market. Now you have to answer the question here. They're saying the pound sterling in the forward market. So pound sterling means a pound has appreciated, means a pound is at premium. Now here we go. The pound sterling in the forward market is being quoted at premium. Yes, it's true, right? The being quoted at discount. No, pound is not quoted at discount because pound has appreciated. The pound is undervalued. How we can say it is undervalued or overvalued? We cannot say anything, right? Without any fact. So actually, this is the first answer is there. Okay, pound is being quoted at premium. I hope so it is clear. So guys, I was thinking we can start 8.4, but 8.4 again, even we cannot complete. Again, still I need few classes, guys, for exchange rate. I'm telling you, we cannot finish it quickly because there are a lot of things to go and I want to go every point in detail. Is that clear? Now, guys, please remember here, sometime in your exam question, he may give you a situation. For example, you are taking a loan in foreign currency, right? And he may ask you to calculate the effective interest rate. So if the question is like that, this is how you will deal. Just going to show that one also. Here we go. Effective interest rate on a foreign currency loan. How would you calculate effective interest rate? So I can explain with the help of example. So the point is when we take a loan, for example, if today I'm taking a loan in the foreign currency, obviously maybe I will convert that currency into my local currency, and today exchange rate could be different. Maybe this loan I'm going to settle after 1 year or 2 years, whatever the period is. Generally, it is let's say 1 year, for example. If I'm going to settle the loan after 1 year, so I would pay interest also. Okay, and maybe the today exchange rate could be different and at the end of 1 year rate could be different, right? And due to changes in exchange rate, my interest rate will increase actually. whatever they are Whatever the bank will tell you, maybe let's say it is 8%, but effectively it will be more than 8% because exchange rate effect is there. I'm not showing it would be more than, it could be less than also if exchange rate will move, positively. So it can also be there. But the point is, how would you calculate effective interest rate? So here we go. When loans are taken when loans are taken out in foreign currency, the appreciation and depreciation of two currencies can affect the value of interest and principal. So it can give you gain or loss also. It may increase your interest rate or decrease your interest rate. The process I'm going to explain, how would you calculate effective interest rate. So this in turn can affect the effective interest rate. And how would you calculate? This is the example we have. For example, a US company takes out a 1 year loan duration. It is how much? The value of loan is how much? 12 million peso. Okay. This is the amount of loan at 6.5%. This is the rate of interest. This is loan value. And this is the rate of interest which bank has agreed with you. Interest rate. Bank interest rate. 6.5%. To pay a Mexican supplier. Why we are taking this loan? Because we maybe have to pay to Mexican supplier. After a year, the US company repays the loan with interest. And now, guys, what is the information they're saying? But in the meantime, okay, the peso has experienced a slight appreciation. So peso got actually strengthened. So thus the companies now here, this is just normal information, no need, because we need exchange rate. What is the exchange rate at the time when we took the loan, and what was the exchange rate when we repaid the loan with interest? So the spot rate means when we took the loan, the spot rate was this: 1 peso equals dollar 0.0921496. But in 1 year, so 1 peso is equal dollar 0.094 tetra zero. Understood? This is the rate now. Now, guys, how would you calculate effective rate? So this process you will follow now. So first of all, you will make this column. Okay. So you will write first of all amount borrowed. How much amount you borrowed? So you borrowed how much? 12 million peso, right? Pesos you borrowed, right? 12 million. And then you will simply what? You will just, this is when you borrowed this amount today. And when you are going to repay this amount in 1 year time. And what's the interest rate? Interest rate, it told you in the question 6.5 here, right? Here, interest rate. So now what I will do, I will just simply I will take amount borrowed. So this all calculations in pesos first, okay? This column. So what? Amount borrowed is 12 million and stated rate is how much? 6.5%. This is the rate of interest, 6.5%. So the equals time charged, sorry, equals what? Interest charge. How would you got? Because stated rate is 6.5. So we have 12 million loan multiplied by 6.5%. So this will give you value of interest, right? This is value of interest actually. So when you will take amount borrowed times stated rate means interest rate, uh, it will be equal interest charge. Now, guys, because you would pay at the end of year total principal plus interest, right? So principal value was this 12 million plus interest value is this 780,000. So total your repayments, which will include principal plus interest, it will be how much? 12,780,000 pesos. Okay, so this we know information in the peso because so far no conversion is there, so no problem. But if you will now if you will now incorporate the exchange rate, so please, spot rate was what? This was the spot rate when we took the loan. 1 peso equals this much dollar. So what I will do, because this currency is in peso and rate is in dollar, so I will multiply now this rate. If I will convert this peso at spot rate, so I will get effectively this much dollar, because peso loan I have taken, right? I will sell the peso. Okay. If I will sell at the spot rate, so in dollar it should be how much? 1,100,000, 105,795. Okay, this is the value. Okay, and then what? Then this is my final principal repayment and interest, right? Principal plus interest. So this value at the end of year, because I will repay to the bank, right? So this I will convert into dollar by using what? This rate, year end rate. Okay, and if I will multiply with year end rate, so this much dollar I will get. Now, guys, listen me what I'm saying here. So the difference of these two value here, if you look just into peso, this value and this value is only the interest is there, right? Because this is only one currency. But here, if you look this here, conversion is applied. And the difference of these two value is this. The difference of these two value is this. Okay, 95, 525. This is not only the interest. This is interest plus exchange rate effect. Okay, this is the interest plus exchange rate effect. Okay, now effective rate, how would you calculate? Here, if you take the difference of these two values, this is the pure interest because no conversion is involved. But here conversion is involved. So if you will take the difference of these two values, so this is not only your interest, it is also includes the factor of exchange rate. But how would you calculate the effective rate now? For effective rate, this formula you will apply. You know your stated rate is 6.5%, but effectively it could be more or less. So effective rate, how would you calculate? Okay. So effective rate. So you will take difference in dollar divided by original amount or amount of loan, original loan. Okay. original value of loan, principal value of loan, principal value of loan. Okay. In dollars, I'm taking now these values. So difference is how much? 95,525. And my original borrowed amount is how much? 100, and this value is the original borrowed in dollar. 1,105,795. Okay, and I will multiply with the 100. Sorry. And I will multiply with the 100 to get the answer into percentage. If you will just get divide, so you will get 8.64%. See, stated rate, it looks like 6.5%, but it is in the peso. But when you convert into dollars, okay, by applying the conversion, and you got the effective rate 8.64%. So as I told you, effective rate could be more or less. It depends which currency is going to weaker or which currency is going to be stronger in the future. Understood, guys? This is how you will deal with the foreign currency loan. If they will ask you to calculate the effective rate, so you have to do this first. Do first calculate these things, and then convert in the original amount, convert into other currency, and then final amount convert into other currency. Take the difference. This difference divided by the original amount. So this will give you effective rate. I hope so it is clear. So guys, I couldn't start 8.4. I was thinking maybe these risks I will finish maybe within 15 to 20 minutes, but it obviously took more than 1 hour. So in the next class, I'll start 8.5 or 8.4. Okay, so from there we will continue in the next class. Thank you so much.